Welcome to Iron Financial. Our mission is to forge stronger portfolios, and we do that by stress testing the market's weakest links. Today, we're putting Constellation Brands, ticker STZ, straight into the crucible. Look, after their last earnings report, the headlines were a complete and total mess. You had one source screaming beat, while another was whispering miss. And then the stock itself, the price action, well, it told a third story entirely. So we're here to do what we always do. Cut straight through the noise, get our hands on the raw data, and figure out if this beverage giant is built on a foundation of solid financial steel, or if it's just a house of cards waiting for the next market tremor to bring it all down.
Right. Let's just get straight to the heart of it, because this is exactly the kind of setup that traps unsuspecting investors. So, April 8th, the day of the big announcement, the stock closes down more than 2%. Now, you tell me, in a market that is absolutely starving for good news, a real, solid, honest-to-goodness earnings beat gets rewarded. It goes up. It doesn't get punished. So how in the world are we supposed to square a stock drop with these flashy headlines all crowing about a beat? It just doesn't add up. It's a huge contradiction, and it tells me that something is buried deep inside that 10Q filing. Something the headline writers either missed or maybe chose to ignore. Our job today is to dig that truth up and figure out if this dip is a beautifully gift-wrapped buying opportunity or if it's a blaring fire alarm that everyone's trying to pretend they can't hear.
Exactly right. And to get to that kind of truth, you can't just wing it. You need a methodical plan of attack. So here's how we're going to break this all down today. First, we're going to dissect that confusing earnings report piece by piece and see exactly where the numbers went off the rails. Then, to give the company its fair shake, we are going to build the strongest possible bull case. We'll look at the numbers an optimist would be clinging to right now. After that, the stress test begins. We're going to examine the core business fundamentals. From there, we'll get to the most critical signal of all. The smart money is heading for the exits, and we're going to show you the data that proves it. We'll touch on the new leadership transition, and then finally, we will deliver the unfiltered Iron Financial verdict. Let's get to work.
Okay, let's dive right into the deep end because the entire confusion, all the noise, it all starts right here. You know, depending on which data provider or news outlet you happen to glance at on earnings day, you were fed a completely different story. It was a masterclass in how surface-level data can seriously mislead investors. Honestly, when you see two reputable sources presenting numbers that lead to totally opposite conclusions, it almost looks like the company is running two different sets of books, one for the public and another one that reflects the cold, hard reality.
Now take a look at this. This slide puts the whole contradiction in black and white. Over there on the left, you've got the data from ChartMill. This is the version of the story that most of the media outlets ran with. They show revenue of $1.92 billion, which just squeaked by the estimate of $1.9 billion. Then they highlight a comparable, or you might call it an adjusted, EPS of $1.90 that handily beat the Wall Street estimate of $1.73. So you look at just those two numbers, and of course you get headlines screaming STZ beats on revenue and earnings. It looks clean, it looks strong, it looks like a win.
But it's a total mirage. It is not the whole picture, not even close. Now look at the right side of the table, the data from Guru Focus. Okay, they report the exact same revenue number, $1.92 billion, but the analyst consensus they were tracking was for nearly $2.4 billion. That is not a squeak-by beat. That is a $500 million miss. It's a catastrophic failure to meet sales expectations. And then look at the earnings. Same $1.90 comparable EPS, but the estimate they were looking at was $3.29. Again, a colossal miss. And here is the real kicker they buried. The actual GAAP reported EPS, the number that has to follow the actual rules of accounting, was a pathetic $1.16. So you see, one source spins a great story while the other reveals a complete disaster. This is why you never, ever, ever trade the headlines.
All right, so we've clearly established the conflict at the very heart of this report. Now, our process here demands rigor. So before we start tearing this thing down, we have to build the strongest possible argument for Constellation Brands. We have to give them a fair hearing. Because despite that incredibly messy report, a dedicated bull would tell you that the company's core financial structure is fundamentally sound. They'd say, hey, ignore the quarterly noise, ignore the Wall Street estimate games, and focus on the bedrock pillars of financial strength that can support this company through any storm.
And the very first pillar, the primary load-bearing wall of the entire bull case, is this right here, a staggering $1.8 billion in full-year free cash flow. Let's be perfectly clear about what this is. This is the lifeblood of a company. This is the pure, unadulterated cash that's left over after the business has paid for all of its operations and all of its capital expenditures. In today's environment, with rising costs and economic uncertainty, cash is king.
and STZ is generating an absolute torrent of it. This isn't some company that's struggling to make payroll. This is a cash-generating machine, and it's powerful enough to fund growth, pay down debt, and most importantly, reward its owners, the shareholders.
And this is what disciplined management does with a torrent of cash. Over $1.6 billion was sent directly back to shareholders in the last fiscal year alone. And look, this wasn't just pocket change. This was made up of a healthy dividend and a very significant $924 million in share repurchases. Now, the bull argument here is that this is proof that management is on the shareholders' side. They aren't off empire building or making frivolous acquisitions. No, they are taking that massive cash flow and using it to systematically increase the value of every single remaining share. It's a tangible, undeniable return of capital, and it's happening at a massive scale.
And now we get to the capstone of the bull case. The board of directors just went ahead and approved another dividend increase. Now, okay, it's a modest 1% bump up to $1.03 per share, but any investor who's focused on the fundamentals knows the actual amount is less important than the signal it sends. A board does not raise its dividend unless it is supremely confident in the durability of its future cash flows. It's a public declaration. It's them shouting to the market, "We believe our earnings are stable and secure enough to support even higher payouts for the foreseeable future." So there it is. The bull case rests on three huge pillars: overwhelming free cash flow, substantial shareholder returns, and a public vote of confidence from the board. On the surface, that foundation looks like it's built to last.
Yeah, looks like it's built to last is the perfect way to put it. Because now it's time for the stress test. It's time to take a sledgehammer to that shiny foundation and see if it's really reinforced concrete or if it's just some painted drywall hiding the rot underneath. You see, that cash flow, that dividend, those are outputs. They're the result of the business. We need to look at the engine itself, the core beer business that's supposed to be generating all that cash. Are the load-bearing walls of this company actually sound? Let's start applying some pressure and find the weak points.
And here it is, the first major crack in the foundation. This chart shows us depletion growth. This is the metric that matters most, folks. This isn't about how much beer they ship to some dusty warehouse. This is about how much beer actual customers are pulling off the shelves and buying from stores and bars. And just look at their two iconic flagship brands, the ones that carry the entire company on their backs. Modelo Special, down 3%. Corona Extra, down a shocking 7%. Oh, sure, there's smaller, trendier brands like Pacifico and Victoria are growing nicely, but that's like complimenting the new curtains while the house is literally on fire. Your two main pillars, the brands that represent the vast majority of your volume and profit, are showing serious signs of consumer fatigue. This isn't some small problem. This is a direct hit to the very heart of the business. So what's the inevitable consequence when the volumes of your biggest products start to fall? Your profitability gets absolutely crushed. This is the second major stress fracture we found. The operating margin in the beer segment plummeted 340 basis points, falling from an impressive 38% all the way down to 33.2%. Think about that. The company is being squeezed in a vice. On one side, you've got higher input costs, things like aluminum for cans, transportation, you name it. On the other side, because they're selling less of their main products, they're suffering from what's called unfavorable fixed cost absorption. It's simple, really. The cost of running a massive brewery is largely fixed, so when you push less beer through it, every single can you do manage to sell becomes less profitable. The bull's precious cash flow machine is suddenly looking a whole lot less efficient. Its primary gears are grinding, and they're spitting out less cash with every single turn. So, let's recap. We have declining volumes in the brands that matter most, and we have shrinking profit margins on every case they manage to sell. That's bad. That's really bad. But now we arrive at what I truly believe is the single most important piece of evidence in this entire analysis. This is the kill shot for the bull case. So I want you to forget the headlines, forget the adjusted EPS, forget the tiny dividend hike. Let's look at what the smart money is actually doing with their capital. Because if you see the architects and the engineers sprinting away from the construction site, you do not stick around to admire the new lobby. You run.
This quote from BitGet News just nails it. It sets the tone perfectly for what's coming next. We are not talking about small retail investors trading on Robinhood here. Whale wallets refers to the massive institutional investors. We're talking multi-billion-dollar hedge funds, huge pension funds, university endowments. These are the players who have armies of analysts, who have direct access to management, who have the resources to find the real truth. And believe me, their actions, where they choose to put their billions of dollars, speak infinitely louder than any glossy corporate press release ever could.
And here it is. This is the number that should keep any potential STZ investor awake at night. In just the last quarter, the total number of institutional owners in Constellation Brands dropped by nearly 31%. Just let that sink in for a moment. This is not a slight rebalancing of a few portfolios. This is not a sector rotation. This is a mass exodus. We are talking about hundreds of sophisticated financial institutions all looking at the same data we are and all coming to the same conclusion at the exact same time. Get us out. This is a 5-alarm fire bell ringing through the halls of the world's biggest and smartest investment firms.
Oh, but it gets worse. It's not just that hundreds of firms are closing out their positions entirely and walking away. The total volume of shares held by all institutions has shrunk by nearly 11%. What this means is that even some of the firms that are still holding the stock are quietly reducing their exposure. They're trimming their positions. The entire pool of smart money invested in this company is evaporating, and it is happening at a terrifying pace. They are actively selling hundreds of millions, maybe billions, of dollars worth of shares into the market. And you have to stop and ask yourself a very important question. Who is on the other side of that trade? It's the retail investors, the ones reading the earnings beat headline.
And here are the receipts. This isn't some abstract trend. Capital World Investors, one of the largest and most respected investment managers on the entire planet, dumped nearly half of their stake. We are talking billions of dollars worth of stock in a single quarter. You see passive giants like Vanguard and BlackRock, who basically have to own the stock as part of their indexes, just staying on the sidelines with no meaningful new purchases reported. Now, the bulls will desperately point out that Berkshire Hathaway added to its position. Okay, fine, but that is one single whale swimming against a literal tsunami of institutional capital that is flowing out the door. The trend is overwhelmingly, deafeningly clear. The big money wants out, and they want out now. So let's just bring this all together and put it to a final test. Let's go all the way back to that signal of confidence that the bulls were clinging to so tightly. On the left, you've got their evidence, a token, 1% dividend hike. It's a press release. On the right, you have our evidence, a massive, nearly 31% collapse in the number of professional institutions that are willing to own this stock, a mass exodus of capital. So I'll ask you, which of these numbers signals real confidence? Is it a symbolic gesture from the board that costs them next to nothing, or is it a real money vote of no confidence from the most sophisticated investors in the entire world? To me, it's not even a question. Actions speak louder than press releases every single time. Okay, that's a powerful and frankly a damning argument. The institutional data is not just a red flag, it's a red flag the size of a billboard. Now, as if all this operational and financial pressure wasn't enough, there's another heavy layer of complexity being added to the mix at the absolute worst possible time, a leadership change. The incoming president and CEO, Nicholas Fink, is taking the helm from Bill Newlands. So the big question for any investor has to be, can this change actually be a catalyst for a much-needed turnaround? Or does it just add another thick layer of risk and uncertainty when the company can least afford it? Well, it's a classic double-edged sword. And the timing here is just awful. It couldn't be worse. On one hand, sure, a new CEO can be a positive thing. It signals that the board finally recognizes the need for a strategic shift. But you're making this transition at the exact moment your core business is showing weakness, your margins are compressing, and your largest investors are stampeding for the exits. This is precisely the moment when you need stability, laser focus, and flawless execution. And instead, what do? You get the distraction, the internal power struggles, and the strategic uncertainty that always come along with a CEO transition. It just adds a huge layer of execution risk right when the fundamentals are already sitting on a knife's edge. Okay, we have laid it all out on the table. We've dissected the conflicting reports that created all the confusion in the first place. We have built a strongest possible bull case based on powerful cash flow and shareholder returns. And then we put that case to a punishing stress test, revealing deep, deep cracks in the core business, and an alarming, undeniable exit by institutional investors. So now it's time to weigh all the evidence. It's time for the iron financial verdict. Is this a solid foundation that you can build a position on? Or is it a house of cards just waiting for the slightest breeze to come along and make it all collapse? All right, let's summarize the showdown. The foundation, the bull case, it really does rest on that very real $1.8 billion in free cash flow and the $1.6 billion in shareholder returns. You can't deny they have truly iconic brand power, and the board did make that confident public gesture with the dividend hike. It's not nothing.
But the cracks in that foundation are turning into gaping holes. I mean, the company itself issued weak forward guidance. The core beer volumes, the very engine of this whole company, are in decline. They are facing severe ongoing margin pressure. And the elephant in the room that just stomps on everything else. you have that massive, undeniable institutional sell-off. When you put them side by side like this, the weight of the bear case is simply crushing the bull case. It's not even a fair fight.
And that brings us to the final critical question for anyone looking at this stock. Some investors, they're going to see the price drop, they'll see that dividend yield, they'll look at the history of strong cash flow, and they're going to think, this is it. This is a buying opportunity, a quality company on sale. But every single piece of evidence we have just walked through points in the exact opposite direction. This is a textbook example of a classic value trap. It looks cheap for a very, very good reason. Those positive headlines about an earnings beat were a facade. They were a distraction from the deteriorating fundamentals. The real story, the one you need to pay attention to, is what the smart money is doing. Their mass exit reveals a structure that is under significant and worsening stress. And they are not waiting around to see if it collapses. They are selling. They're selling to the people who are still buying the headline.
So here is our final, unambiguous verdict. That institutional exodus is not just a warning sign. It is a blaring 5-alarm fire. The structure of this company right now is not sound.
And that small dividend hike? From this perspective, it looks less like a signal of genuine confidence and a whole lot more like a calculated move to prop up the stock price, to create a positive headline to distract from all the bad news, and maybe, just maybe, provide enough liquidity for those institutional sellers to get out at a better price. It looks like a pump. Our advice is simple. Pay attention to the SEC filings, not the headlines. Follow the actions of the smart money because their capital is on the line.
And that is our core mission here at Iron Financial. It's to give you the tools and the analysis you need to distinguish between a solid investable structure and a dangerous facade. In the case of Constellation Brands, the smart money has spoken loudly and clearly, and they are saying this building is not safe for capital. The takeaway is clear. In a market that's full of contradictions and noise, you find real strength by following the smart money. Thanks for joining us. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.